At the start of 2025, China Vanke Co. Limited once again found itself at the center of public controversy. On January 10th, Vanke's debt issues triggered market panic, causing a sharp drop in both its stock and bond prices, resulting in a new round of dual slumps. As a leading enterprise in the real estate sector, Vanke's predicament is not only a reflection of its own operational challenges, but also highlights the structural issues plaguing the entire Chinese real estate industry. Background of the debt crisis. Approaching debt maturity peak. According to Vanke's public data, the company faces repayment obligations for 10 bonds or medium-term notes totaling 22.523 billion renminbi in 2025. However, as of the third quarter of 2024, the company's monetary funds amounted to only 79.5 billion renminbi, while short-term borrowings stood at 8.7 billion renminbi, and non-current liabilities due within a year totaled 111.5 billion renminbi. Overall, the debt shortfall exceeds 40 billion renminbi. Deteriorating operational performance. Vanke's performance over the past year has further exacerbated market concerns. In the first 3 quarters of 2024, the company reported revenue of 219.9 billion renminbi, down by over 100 billion renminbi compared to the same period in 2022. Net profit attributable to shareholders turned from a surplus of 15 billion renminbi in previous years to a loss of 17.94 billion renminbi. This decline in financial performance also reflects a significant weakening in its core business capabilities. From a revenue perspective, Vanke's traditional real estate business suffered from the broader market downturn, with sales plummeting, key projects experiencing sluggish demand, and a sharp drop in payment collection efficiency. Meanwhile, its non-core businesses failed to compensate for the decline, and high operating costs, especially in land reserves and project development, further squeezed profit margins. In addition, Vanke's debt-to-asset ratio rose to a historic high in 2024, intensifying the pressure of debt repayment. The company's long-standing reliance on high-turnover strategies proved unsustainable in the face of weak market demand, leading to cash flow constraints. Over the past 3 quarters, the company's net cash flow remained negative, and tightened financing channels compounded its difficulties. Market reactions. Dual slumps in stocks and bonds. Persistent decline in stock price. Vanke's stock price has been in a continuous decline for 6 consecutive years, with its market capitalization shrinking from a peak of 400 billion renminbi to less than 80 billion renminbi. This staggering loss, amounting to over 80%, underscores the market's pessimistic outlook for the company's future. In 2023 alone, Vanke's stock price fell by nearly 40%, and in 2024 it continued to decline by over 30%. Within the first 10 days of 2025, its stock price dropped another 7.85%, hovering near its historical low set in August 2024. The protracted slump in stock price reflects investors' doubts about Vanke's short-term operational capacity and the lack of confidence in the broader real estate sector. Under the dual pressures of high debt and declining sales, Vanke has faced consistent cold reception in capital markets. Sharp decline in bond prices. On January 10th, the bond market swiftly reacted to negative news about Vanke. Prices for the 21 Vanke 06 bond plunged by over 8%, while 22 Vanke 04 dropped by over 12%, and 22 Vanke 07 fell by more than 5%. The steep decline in bond prices directly reflects investor concerns over Vanke's debt repayment ability. With the added risk of potential credit rating downgrades, Vanke's financing channels are expected to face further limitations, exacerbating its liquidity challenges. The pessimistic sentiment in the bond market also triggered a wave of sell-offs of other real estate bonds, creating a chain reaction of industry-wide turmoil. Catalyst for the crisis. Controversial guarantees. Recently, a series of guarantee arrangements by Vanke have drawn public attention. Long-term guarantee risk. Vanke provided a 1.08 billion renminbi guarantee for its subsidiary Shenzhen Bolin, with a term as long as 30 years. However, Bolin's total assets amount to only 504,900 renminbi, with net assets of less than 30,000 renminbi and zero revenue over the long term. The market has raised concerns about the subsidiary's operational capacity and flagged this as a sign of liquidity issues within Vanke. Broader industry context. The ongoing downturn in the real estate sector has amplified Vanke's challenges. Industry-wide events. On January 9th, Country Garden saw its stock price plunge due to an aggressive debt restructuring proposal, which included a 90% debt reduction and an extension period of up to 11 years. This plan heightened market concerns over the repayment capacity of real estate companies. Vanke's monthly sales in 2024 fell drastically, from over 30 billion renminbi in 2023 to as low as 14 billion renminbi. The lackluster performance in its core business further eroded market confidence. Factors such as poor project positioning, prolonged clearance cycles, and cautious buyer sentiment contributed to the slump. Even during traditional peak sales seasons, monthly sales struggled to exceed 20 billion renminbi, creating a sharp decline that further constrained cash inflows. Vanke's response measures. Facing mounting scrutiny, Vanke issued a response to its debt issues on January 9th, outlining several measures. Raising funds. Efforts include payment collection from sales, bulk transactions, divestment of non-core businesses, and securing additional financing resources. Internal adjustments. The management team implemented pay cuts, with Chairman Yu Liang receiving only a symbolic salary of 10,000 renminbi and leading the team to collectively contribute 200 million renminbi to purchase company shares. Organizational restructuring. Recent leadership changes aim to enhance execution capabilities on the sales front. While these measures are necessary steps to address liquidity challenges, significant obstacles remain. Sales pressure. Vanke's monthly sales figures remain weak amid sluggish real estate demand and low consumer confidence. The strategy of relying on payment collection offers limited relief, as repayment cycles are long and immediate debt pressure persists. Financing challenges. With credit ratings downgraded, obtaining new financing has become more difficult and costly, further eroding profit margins. Symbolic adjustments. Pay cuts among management serve more as a public relations move than a meaningful financial solution. The management's purchase of shares is a short-term measure to stabilize market sentiment, but offers limited impact on the fundamental issues. Outlook and implications. Vanke's challenges are a microcosm of the systemic risks facing the real estate industry. Its ability to navigate the current crisis hinges on several key factors. Improved cash flow. Achieving significant sales growth and ensuring rapid payment collection are critical to alleviating debt pressures. Debt restructuring. Optimizing the debt structure through extensions and restructuring must avoid further undermining market confidence. Policy support. Government measures to stimulate the real estate sector could enhance overall liquidity. In conclusion, Vanke's current difficulties not only affect its future development, but also hold broader implications for the trajectory of the real estate industry. For investors, caution is warranted before the market shows clear signs of recovery.